Okay, so final Q&A, anything goes. You do not have to stay on mute. You can come off and ask me questions. There's also the chat is open, and if I don't see it, just maybe send me a message, say, oh, there's a message in the chat. This is all about you, but I have prepared a presentation of things which I feel haven't been tested for a while, and there isn't really a revision question on it. And so I wanted to just cover some smaller areas. So let's start with my little agenda. So we're going to go through leases, but looking specifically at lessor accounting, that we have not seen a past exam question on recently. Deferred tax, there was no share-based payment deferred tax that we wanted to go through. IFRS fair value, I don't feel we had one question, but I want to just go over that again because it's a really easy topic. And if it comes up, it's easy marks. Then I'm really focused on discontinued ops because IFRS 18 has come in and potentially that is something that could happen in your exam. And then hedges, cash flow hedges and fair value hedges. And then finally, just going over again, IFRS 18, the sorts of things which they have said how it will be tested. Now, we have gone through quite a few of them, but I do want to just focus a little bit on some more areas which they could test you on. So first of all, we're looking at leases, IFRS 16. We've done to death less accounting, where we've done sale and leasebacks, we've done right of use assets, lease liabilities. You've managed all that quite well. We've talked about ratio analysis to do with them. So we've covered that quite a lot in the revision course. But what we haven't covered is lessors. Now, lessors is an SBR topic. It's not a financial reporting topic. So it should really be tested in more detail because it's a new topic. So remember, IFRS 16 says that lessors must now classify leases into finance leases or operating leases. Lessees, we don't. It's either a lease or it's not. It's either a short-term lease, which has that lease exemption, or a low-value lease, or it is a lease. So with lessor accounting, though, we need to know the difference between a finance lease and an operating lease. So a finance lease is a lease where all the risks and rewards of the underlying asset substantially gets transferred to the lessee. Now, there's 5 indicators of them. I'm not going to go through those 5 indicators, but hold on to your hats and remember this. It's where the risks and rewards of the underlying asset is transferred to lessee. Evidence of that is where the lease term is equal to the useful economic life, or where the fair value or the present value of the future lease payments is equal to the fair value, something like that. There are a few little more. Go and have a look at those and maybe get a couple more in your head. An operating lease is basically not a finance lease. So this is from the lessor's point of view. Now, why is it important? Well, we treat them differently for accounting. If it's an operating lease, look on the right-hand side for now, then we keep the asset. We do not de-recognise it. We keep the asset. It's our asset as a lessor. And we take the rental income straight line over the lease term into the profit and loss, and we depreciate that asset. Now, with IFRS 18, you'll need to think about where those rental income and depreciation goes. Well, it's obviously operating if you're a lessor, because that's potentially the business you're in. Now, it might not be if you're a lessor, if it's something you just do as something you've done as a side hustle, shall we say. And therefore, you might have to think about whether you are doing an operating lease because it's something that's not your normal course of business. And then you'll have to decide whether that is really investing. It could only really be operating or investing from a lessor's point of view. And it's more likely to be operating. Now, from a finance lease point of view, you're investing now in the lessee, okay? So you need to de-recognise the asset and you have a net investment in the lease, which is like a financial asset, a financial investment in somebody. And so that is the present value of the minimum lease payments, plus any guaranteed or unguaranteed residual values. So you have to present value every item of money, cash that you are getting from the lessee, okay? And that becomes your investment. Now, again, if you are normally a lessor, that should, therefore, any finance income should be going into the operating section. But if it's not normally a lessor, this is a side hustle, then that would be an investment income. Okay, there's no depreciation, there's no asset in the books. So let's have a look at how that works from the finance lease point of view. Does anybody have a question? Just checking. Okay, so here's my question. Able Leasing leased an item of equipment to a customer commencing on the 1st of January. The expected life of the asset is 8 years. The terms of the lease is 8 annual payments of 4 million. So the 8 years matches the 8 annual payments. So therefore, potentially the useful economic life of the asset is equal to the lease term, therefore a finance lease. The lessee guarantees the residual value of the assets at the end of the lease will be 2 million, although they're able to potentially sell it for 3 million. So the guaranteed residual value is 2 million. The unguaranteed residual value is 3 minus 2, 1 million. So we're going to get an extra unguaranteed amount potentially. The present value of the lease payments, including the residual guarantee, is 25.9 million. The residual guarantee is included in that 25.9, but the unguaranteed amount of 1 million is not. That says it's equivalent to the purchase price. The purchase price we can consider is the fair value. So we are basically investing in the lessee, and so therefore this is a finance lease because the useful economic life is the same as the lease term, and the fair value of the asset is equivalent to the present value of the lease payments. And so that's an indicator that you're getting the capital value of the lease back plus some finance income. So therefore, discuss the accounting treatment. Discuss the accounting treatment is this is a finance lease for those two reasons. And now I'm going to show you how you would put it into the accounts. So the arrangement is a finance lease because as the lessee uses the asset for its whole economic life, and the present value of the lease payments is 25.9 million, which is the same as the fair value of the asset. Done. Now we recognise the present value of the lease payments as an investment, 25.9, but we need to take into account that residual value, and therefore the 1 million discounted back by 8 years is 0.6. So 26.5 is what our investment is. So what we would do is we de-recognise the asset, create a profit on disposal of 26.5 minus the fair value of the asset, and then we create a lease receivable. And therefore at the beginning it's 26.5, interest at 1.6 because it's 6.2%, the lease payment was 4, and they're carried forward, therefore is 24.1. So making sure you understand lessor accounting is important because it's a nice little calculation to get right and a nice little understanding of how to account for them to get right. And this is for finance leases, not operating leases. Okay. The other thing that can come up in lessor accounting is subleases. There is a question out there which hasn't been released by the ACCA. And that's potentially because it's still out there and you're going to be tested on it. And it basically is there is a head lessor, an intermediate lessor, and then a lessee. So lease 1 is the head lease, which goes to entity B. Entity B is two things. It is a lessee of the head lease, but is also an intermediate lessor of the sublease. So how do we deal with it in entity B? Well, remember, the intermediate lessor can either be a finance lease or an operating lease, but they're always a lessee of the head lessor. So if you're a lessee, you have a right of use asset and a lease liability. When you become a lessor, that right of use asset might have to go, if it's a finance lease, and be replaced with an investment in the lessee. Okay? But if it's an operating lease, it's not. It's just left there. But the lease liability always remains, whether it's a finance lease or an operating lease. Let's just go through that again. So if it's a finance lease, then you de-recognise the right of use asset. relating to the head lease, because you no longer have a right of use asset because you've now got a finance lease with the sublease. You instead recognise a net investment in the sublease, and you recognise any difference to the P&L. So that is effectively a profit and loss on disposal, using the investment as the proceeds and the carrying value of the right of use asset. You then retain the lease liability. That never changes. If it's an operating lease, you do not transfer the risks and rewards to the lessee, and you retain the right of use asset and the lease liability. Number 4 is always the same, retaining the lease liability. You recognise depreciation charges and interest on the lease liability, and you recognise lease income from the sublease. Nothing changes. So number 1 is the harder one, because you're basically having to de-recognise your right of use asset. Number 2, the operating lease, is not. You're just recognising lease income over the lease term on the sublease. So the question here I got from my notes, which I did on tuition, is on the 1st of January, Amelia enters into a 4-year lease for a machine with monthly rentals paid in arrears to Lucas. The present value of the minimum lease payments is 2 million, and no initial payments were made to enter the lease. So for that lease on the 1st of January, we would have recognised a right of use asset of 2 million, and we'd have recognised a lease liability of 2 million. There were no initial payments, so there's no deposit. So the right of use asset is the same as the lease liability. We then move it on 2 years. 2 years later, Amelia then subleases this machine to a ratio for 2 years. Now, the present value of the sublease's minimum lease payments is 1.2 million. Amelia has correctly classified the sublease now as a finance lease. And the carrying amount of the head lease liability is 1.1. So the lease liability has moved to be 1.1 now. The right of use asset will have moved by 2 years' worth of depreciation. And so what we've got to do is find the carrying value of the right of use asset to be able to de-recognise it and re-recognise that 1.2 million net investment in the lease. So let's have a look at how that works. So the sublease is a finance lease, meaning the risks and rewards of the right of use asset transfer to Horatio. So we de-recognise the right of use asset. Remember, it would have been depreciated over 4 years, and therefore it's now 1 million. Okay, so 2 million divided by 4, therefore 2 years have gone by, it's now 1 million. We now record the net investment in the lease receivable, which is 1.2 million. So we now basically create a profit and loss on disposal of 1.2. So that's your double entry. Debit net investment in sublease, credit right of use asset, profit on disposal. We then retain the lease liability relating to the head lease at 1.1 million. I would learn that process in case it comes up. What a lovely thing to be able to do that a lot of people will not be able to do. It's just something that I think you should have a go at being able to do. Hopefully it comes up then if you've done it, and then everybody else won't know how to do it. So that'll be something that we can all focus on our thinking, way, that's great. We've got some marks which other people probably have not got. So learn that process. If it comes up, you just need to just slot the numbers in. And I hope this does now come up now we've gone over it. Any questions on this? Anybody got any questions on leases? Lessor accounting. Has anybody actually gone over this? Or has it gone off their radar?
I have a question.
Yep.
If it was leasing office space and you only sublet like 50%, would you only de-recognise 50% of the?
Yes. Yeah.
Yeah.
Okay. Good question. Okay, right. So now we're going to move on to share-based payment and deferred tax. Share-based payments we've done to death on the course. We did share-based payments bite size. And this is one of the questions from share-based payments bite size. And so I'm just going to go through the accounting, and now I'm including the deferred tax. So share-based payments, being share option schemes, only get a deferred tax implication. And that's because the accounting treatment is different to the tax treatment. Remember, we only get a deferred tax consequence when there's a timing difference between the accounting treatment and the tax treatment. So with share appreciation rights, they're pretty much the same. So we don't tend to have a deferred tax consequence, because with share appreciation rights, we're always accruing the intrinsic value. Now, the tax regime normally gives us a deduction at the intrinsic value when the share options are exercised. Okay, remember, with share options, we don't accrue at the intrinsic value. We accrue at the grant price, the fair value of the grant price, and therefore the fair value of the share option at the grant date. So I call that the grant price, and therefore that's always disallowable in the tax comp, because the taxman doesn't allow that until the share options are taken up by the holders, and you are therefore allowed to put through an intrinsic value, the share price minus what they were exercised at, and therefore that is your tax deduction. So for share options, we need to do two calculations. We need to do the accounting, and then we need to do the accounting again, effectively using the intrinsic value. So if we go through this, 1st of January, they implemented a share option scheme. Each of the 200 managers were granted 10,000 share options that vest on the 31st of December, provided they still work for Edison at that date. So 31st December, XT8. So you've got XT6, XT7, XT8. So it's a 3-year vesting period. The exercise price of the options is $8.50 each. That's the exercise price. That's not the fair value. That is what they have to pay the company to exercise those options. They then will get a profit based on what the market price is at the time. So then on the 1st of January, the fair value of the share options was $2.80. So the fair value is what we would accrue these options at. And remember, with an equity-based scheme, that never changes, that $2.80. On the 31st of December, the fair value of one of Edison's shares was $11.50. So if they were able to exercise these options on the 31st of December, they would make an intrinsic value of $11.50 minus $8.50, $3. That would be the profit they make. But they're not. They can only do them at the end of XT8. So on the 31st of December XT7, it was expected that 90% of the share options would vest. The year before, when we accrued them, though, which we have to do every year, remember, they correctly recognised the share option expense of 1.792 million. Taxation is at 20%, and relief is given on the intrinsic value. So what do? Well, we have to do the accounting separately from the tax. Let's have a look at what we're doing. So first of all, the accounting. So the grant of share options is an equity-based settled scheme. This is recognised as an expense over the vesting period, with a corresponding credit posted as a separate component of equity. This is you writing about it. The transaction is measured by reference to the fair value, which is $2.80, not the intrinsic value. The number of options will vest depend on the service condition, being the requirement that managers remain in employment by XT8, so this is 3 years. And so at each reporting, the measurement of the transaction is updated to reflect the expected number of options that will vest. Therefore, we are going to put through a cumulative expense at $2.80, taking into account the 200 times the 10,000 options times 90% of the people expected to be there, times by 2/3, because we're in the 2nd year of the vesting period. And therefore the expense recognised is taken off from XT8, and we're left with 1.568. That's the accounting. So remember, the cumulative expense is 3.36 million. We now need to do the deferred tax consequence. We're not allowed that expense. That is based on the fair value. It's not based on the intrinsic value. So the share-based payment is recognised as an expense of the profit and loss. Tax relief is not granted until the exercise date. This date delayed tax relief is a deductible temporary difference, and the tax relief is given at the intrinsic value over the vesting period to match with the expense. So how we calculate that is the number of share-based payment times by the intrinsic value times by the times by the tax rate. So, but we cannot give it fully to the P&L if the future tax deduction exceeds the cumulative share-based payment expense. Any excess has to therefore go to equity. So that's why it's important to know the accounting and the tax value. So the tax base is calculated as follows. Same calculation, but all we're going to do is replace the 280 with the 3. So now there is an excess. So the deferred tax asset arising will be the 3.6 times 20%. Normally, everybody, we would go debit deferred tax asset, credit P&L tax. Okay, credit P&L tax to get the asset in the books. And what that is doing is basically showing to our shareholders that we'd have a tax deduction for our share-based payment that is going through our P&L. It's a timing difference. The problem is, though, the 3.6 million is greater than the 3.36 million by 240,000. Therefore, 48,000 of that needs to get credited to equity. So it goes straight to equity. And so it basically goes 720, 480 goes straight to equity, and then the P&L tax credit is 672. So that is another little item that could get tested that isn't in any of the past questions I can see in your text, your kit. So I wanted to make sure we covered that as well. So all you need to remember is it's the intrinsic value, the same as the accounting. You just replace the fair value with the intrinsic value. And if that cumulative expense is greater than the accounting expense, the excess times the tax rate goes to equity. Okay. Any questions on that while I'm here, just before I move on? So IFRS 13, I just want to go through the basics of IFRS 13 in case they come up and therefore you're able to do it. It's normally part of a question and can even be part of a question with another type of IFRS. So something like investment property or property, plant and equipment, and you've got to fair value it, and then they ask you. Or it could be a financial instrument, so you've got to value a financial asset. Okay. So remember, priority is given to level 1 inputs. Lowest priority is given to level 3 inputs in the old fair value hierarchy. So remembering the definition, fair value is a value given to market participants would put on a value. It's not an entity specific one, it's a market participant one. So it doesn't matter what you're using the asset for, it matters what the best market would use the asset for. So IFRS 13 establishes this 3 hierarchy. Number 1, it would be quoted prices on active markets. So basically share prices on the stock market, think of it like that. Level 2 would be quoted prices for similar assets in active markets. So if you're an unquoted company and you've got a similar company on the stock market, then you could use that. Identical or similar assets in less active markets. That could be if you've got rental prices, square footage for a similar property or the same property in a less active market. And then unobservable inputs is level 3, where you use estimates of cash flows or profit forecasts. Normally, that is where you're trying to value a liability or a provision, okay? So you would look forward, look at the cash flows that you're going to have to pay out in the future, and then present value them and taking into certain risk factors. So really, that would be something that the examining team would have to write out and tell you. And we'll have an understanding of that in a minute. So markets. Remembering if you're using active markets, you now need to think about, or inactive markets, the principal market for which the asset or liability is in is the one that you use. And the principal market is the one with the highest volume, highest activity that the entity can access. It's not the highest activity for the entity, it's the highest activity for everybody, the biggest market. Okay. In the absence of being able to find a principal market, then you use the most advantageous market to the entity. So that's the one where they make the most profit. But remember, fair value only takes into account transport costs. It excludes transaction costs. And that is because transaction costs are entity specific. So we only take into account transport costs. But obviously, when we're doing the advantageous market, we do take into account all of it, all costs, to find out the most profitable one. Can be slightly confusing, but it's obviously tested. So I've got this example near hand, which is a past exam question, and it wishes to fair value inventory of the entity acquired. There are 3 different markets for the produce, which are mainly vegetables. Farmers tend to sell all of the produce they can in the export market. When they do not have any further authorization to export, they sell the remaining produce in 2 domestic markets. It's difficult to obtain information on the volume of trade in the domestic markets. We have no idea. It's unknown. But Monty feels that Mehrhan, I've changed the figure, feels that the market is at least as large as the domestic market, direct to manufacturers. So we obviously have a big market there. The domestic market direct to manufacturers is 20,000 tonnes. The export market is 10,000 tonnes. And the domestic market is unknown. So we have an issue here. Okay, we do have a highest volume market, being the domestic market manufacturers. But notice Mehrhan's is only 4 tonnes, right? Mehrhan's is only 4 tonnes. So don't get tricked into thinking that that isn't the principal market. Really, if we'd known what the domestic market were and it was lower, then that would be the principal market. It's nothing to do with the entity. Okay, the entity's principal market is obviously the export market. But this is a market-based measure, so we've got to look at the principal market from all players. Now, because we've got an unknown there, here in this question, you're able to say, we don't know which one the principal market is. So therefore, we would go for the most advantageous market. And then you look at the prices, you can see that the most advantageous market will be the export market. So when we look at this, to get the marks, you need to go through the process. So in this case, the greatest volume of transactions is conducted in direct to manufacturers. And therefore, if we were going to use that as the principal market, the fair value would be 800 minus 70, taking into account transport costs only. But because of the lack of information, the most advantageous market could be presumed. You could say could be or will be. We're just doing a discussion here. So the most advantageous market is the export market, which is 1,200 minus 100 minus 6. Remember, you take into account selling fees. Therefore, the fair value, though, would only be 1,100. So that's the way I would go through that. Don't get yourself into a pickle by going straight to the answer. Think about going through the discussion. We have a principal market, although there is uncertainty over that principal market because of the domestic market direct to retailers. Therefore, let's have a look at the advantageous market. If we use the advantageous market, then it would be 1,100. Keeping your answer alive, okay? Are there any questions on that one? Now, the only other type of question they tend to get, other than calculating a decommissioning provision, which is just basically following the figures, this is now effectively a level 2. Non-current assets, we need to think about valuing the asset in its highest and best use, or by selling it to another market participant who would use it in its highest and best use. So it's not entity specific again. Takes into account physically possible, legally permissible, and financially feasible. Please learn that. So Mehan again has come up with a nice example on this. It has a piece of land which is currently used for farming. The fair value of land used for farming is 5 million. If the land is used for farming purposes, you get a tax credit, which you would add to that 5 million because it's a benefit. And so based upon the lower of 15% of the fair value of the land, or 500,000 at the current tax rate. The current tax rate in the jurisdiction is 20%. So you can use that following the analysis on the question to value now the land if used for farming. But there is another alternative use, which is residential. And the cost to fair value land for residential purposes before any costs is 7.4 million. But we've got costs to convert it to be physically possible, financially feasible, obviously, and legally permissible. And so those need to be taken into account. So in order to transform the land into residential, you've got legal costs of 200,000, a viability analysis cost of 300, and cost to demolition of the farm buildings 100. But there is also a risk factor, which is to do with the planning permission of 20%. So how do we therefore do this? Well, we go through the process, value it on both bases to get the marks. Do not just go straight for the one which is the highest and best use. So the current use needs to reflect that tax credit, and the lower is therefore the 20% of the 500,000. So therefore it would be 5.1. If used for residential purposes, you need to go through the process. It takes account of physically possible, legally permissible, and financially feasible. Demolition and preparing the land should be included in the valuation, and the uncertainty risk factor. So therefore 7.4 minus the cost and then times that whole value by 80% because of the 20% risk factor would be 5.44 million. Therefore the land would be 5.44 on the highest and best use. So again, this comes up. This is a really good question. It is in, I think, one of the practice exams now. So it could come up in a different vein in your mock, obviously. They could be valuing anything. But using these fundamental principles will help you to get through those questions. How are we on that? I quite like fair value. I think it's easier to understand and remember. So hopefully, please remember. Please just go through a decommissioning provision, understanding how you do the present value of it. Handy foot was also something that was valuing a provision in the future. And so basically all you're doing is finding a future cost and discounting it back to today's money. Okay. Any questions? All right. Okay. So now I've got discontinued ops. So we've done to death on the course held for sale. So I'm not going to go through the held for sale criteria. I just want to remind you of a discontinued operation. Now, a discontinued operation is effectively a division or a subsidiary that has been disposed of in the year or has been classified as held for sale in the year, but it has to represent a separate major line of business or geographical area. So when we do disposals in changes in group structures, it's not always considered a discontinued operation, okay? Just to be clear on that. The examining team will have to make it clear by saying to you, this represents a separate major line of business or geographical area. They will be making it very clear that it's a discontinued op. If they don't mention it, then it's not. So don't overthink it. You can write it in your answer if you want to say something. I'm assuming this is not a discontinued operation, okay? But I think this time around they will do a discontinued operation. When it isn't a discontinued operation is if it's a subsidiary and you've still got another subsidiary which is operating in that line of business. Therefore, it's not a discontinued operation if you've got two subsidiaries operating in the same line of business or potentially operating in the same geography. So sometimes it isn't a discontinued operation if it's been disposed of. So, and often in exam questions, it's not, but I think this time it will be. So let's hold on to your hats and have a look at this. So it's been disposed of, or it's been classified as held for sale. So they could say it's classified as held for sale, okay? Or it's a subsidiary that they acquired exclusively with a view for resale. Okay, so there's only three options: disposed, held for sale, acquired with a view for resale. And that's like Richard Branson, Virgin, buys a load of companies, only wants to keep three of them, and therefore is going to dispose of some of them because they don't fit. But he had to buy all of them because they were part of a group. That's how that would happen. So hopefully in your heads, you know what a discontinued op is. So this is my example from my tuition notes. Titan is a parent of two companies, Cronus 100% and REA 80%. It decided to sell its investment in REA on the 1st of October. And that was partway through the year because our year end is the 31st of December. So it sold it 9 months into the year, decided to sell it 9 months into the year. And that's when it was classified as held for sale. So at that point, it became a discontinued operation. So we would consolidate 9 months in continuing, and 3 months will therefore be discontinuing. Okay. Now, if we disposed of it at that date, yeah, then the disposal would all be considered discontinued. So the 9 months. So it's very difficult, isn't it? You've got to think what is happening in the year. Here, because it's held for sale, we've had it for the whole year. 9 months would have been continuing, 3 months will be discontinuing. If it was a disposal of 9 months, then the whole 9 months would be discontinuing. And we obviously don't consolidate the 3 months. So the consolidated carrying amount of the net assets of REA was 320 on the 1st of Jan. Goodwill was 338, and NCI measured at proportionate share of the fair value. The fair value less cost to sell, remember this is held for sale criteria, is 395, and the total comprehensive income for the year is 48 million. We're being told all of that because we've got to write this subsidiary down to the 395, fair value less cost to sell. And so we need to know what the carrying amount was at that date on the 1st of October. And to get that carrying amount, we need the net assets, the goodwill, and we need the 9 months of the 48 million. So let's go through the answer. So the investment is classified as held for sale 9 months into the year. So 9 months of the total comprehensive income for the year needs to be added to the carrying value of the net assets from January. Therefore, that is 356. Goodwill has not changed since acquisition and remains at 38, but it's calculated using the partial method. Unfortunately, you've got to remember when you're doing impairment testing or the held for sale criteria, you need to gross up that 38 because that only represents the parent's goodwill. And so we need to add notional goodwill to it, calculated as so. So therefore, in order to write that down, those are my net assets, that's my goodwill and notional goodwill. The fair value less cost to sell is 395, so we need to allocate 8.5. Now, because the 8.5 is less than the goodwill and the notional goodwill put together, that notional goodwill is not in the accounts. It's just a memo adjustment. It's just something we need to take account of when we're allocating because we need 100% of the carrying value of the assets to compare to 100% of the fair value less cost to sell. So only 80% of that 8.5 is the journal. And so that journal would be credit goodwill, debit profit and loss. Okay, that would be the impairment. So then 3 months of the year's results from revenue to profit and loss for the year needs to be taken out of continuing and classified as discontinuing. And the goodwill impairment is allocated to discontinuing profits because it's to do with discontinuing the business. Normally, that would be in continuing in the operating section, but because we're now classifying this as held for sale and discontinued op, that needs to go to discontinuing profits. So in your exam answer, in the pre-populated spreadsheet, they will already potentially they'll say that they have consolidated the full year of REA. In order to adjust and correct, you need to take out 3/12 of everything all the way down, add that up, and therefore taking out 10.5 of profit. You put that into discontinuing like so, move it out of all the areas, put it into discontinuing, and then that 6.8 impairment of 6.8 therefore goes to profit on discontinued operations. So I think that is how it could be tested. And I'm showing you a very simple and easy way of what you have to do. You need to take out the discontinued portion and then also allocate any profit and loss or write down into discontinuing. How's everybody on that? Is everybody clear on that one? Any questions? So we're now going to go through derivatives and hedging because it's something the students don't like, I know. So basically, a derivative is its value changes into response to an underlying instrument. It's like sits on top of an underlying instrument, like interest rate, exchange rate, or commodity price. You're taking out the derivative either for speculative gain or a hedge. If it's a speculative gain, it is simply a derivative that you're using to make money from. So it's fair value through the P&L. It requires little or no upfront investment unless it's an option where you have to pay a premium, and it's settled at a future date. And so we need to fair value it at year end. You do not fair value it at inception because it's got no change in value. You only fair value when you're at your reporting date. And if it's making a loss, you have to create a financial liability and put a loss through the P&L. If it's creating a gain, then you create a financial asset and put a gain through the P&L. Now, where do we put it through the P&L? We have to look at the fundamentally behind the instrument. Are you doing it as an investment? Well, therefore it will go through investing. Are you taking it out as a hedge? Well, if you're taking it out as a hedge, then you need to look at what the underlying instrument is doing, and therefore you match it in the operating section, investing section, or financing section. So let's have a look at that. So remember, always fair value through the P&L. Hedge accounting, there's two types of hedges, a fair value hedge and a cash flow hedge. But both of them have to pass this criteria. Please learn it. Formal documentation exception. A hedging relationship consists only of eligible items. There needs to be an item and a derivative, okay? And they need to meet the hedge effectiveness requirement, i.e. the hedging relationship needs to have something a risk which is going up or down, and the derivative needs to be offsetting that risk. And therefore there needs to be an economic relationship between the two, i.e. they will move with each other. So crude oil forwards and diesel, okay? You can't have crops and diesel crude oil hedge. That doesn't work, okay? It's important to note that if it's a financial item, a liability, a loan or something, and you're hedging interest rates, the credit risk does not dominate the fair value changes. So the fair value isn't changing because of your credit risk. It's changing because the market risk is moving or the market is moving on the loan, okay? And then the hedge ratio needs to be similar, the quantity. So you know there's contract sizes out there for forward forward contracts. And so you need to have the same number of contracts effectively matching your risk. So if the contracts are nowhere near the same as your risk, then there's no hedge effectiveness. Okay. So if you've got those hedging criteria, you then need to determine whether it's a fair value hedge or cash flow hedge. A fair value hedge, just think you've got the item and the derivative, and therefore you basically inventory and a forward contract on inventory price. Therefore, you've got your inventory and you've got the forward contract. Therefore, it's a fair value hedge. And you basically fair value both of them and offset the gain or loss. Now, if it was inventory, that would therefore go in operating. Okay, but if it was a financial asset, then that would need to go in investing. If it's a cash flow hedge, you fair value the cash flow and the derivative, the cash flow risk. You fair value that and you fair value the derivative. You don't have the item, so you can't put the cash flow item into your accounts. And so what happens is you only put the derivative into your accounts, and the other side has to go through other comprehensive income to a reserve, waiting for the risk to materialize. Think about it. You do not have the cash flow risk yet. That hasn't happened. You're taking the loan out in the future. You're worried about the interest rate going up. So you take out a forward rate agreement. Therefore, you have the derivative, but you don't have the cash flow item risk yet. And so you've got to leave the gain or loss in equity ready to use when the gain or loss happens. Any overhead excess goes to the profit and loss. So this is a cash flow hedge. The company enters into a derivative contract in order to protect its future cash flows relating to a financial asset. The relationship was documented as a cash flow hedge. So by year end, the loss in respect of the future cash flows amounted to 9,100. So the future cash flow loss is 9,100. You haven't made that loss, but it's a future loss out there that's probably going to happen. What is the treatment if the hedge instrument that is there to offset that loss has now got a fair value of 10,000? So it's making a gain. So it's well absorbing that loss. In fact, we're making an excess of 900. Now, if it was making less than that 9,100, then you would simply put the financial asset into the account. Remember, not the cash flow loss, because it's going to be waiting for it. But it's not making less than the 9,100, it's making more. So the risk is 9,100, the derivative is 10,000, therefore there is an overhedge. So to get the financial asset into the books, we absolutely put the whole lot in. OCI is therefore showing 9,100, but any excess goes to the P&L. Everybody happy with that? Because you can take that gain straight away because you don't need it. Anybody else got any questions on that one? Now, if there's a discontinuation of a hedge, then basically the hedging instrument is expired, sold or terminated. It no longer meets the hedging criteria, and any forecast future transaction is qualified as a hedge item is no longer highly probable. And this comes up in exam questions too. So what we need to do, if any of those three happen, then we discontinue the hedge prospectively. No entries posted to date are not reversed. So any amounts in reserves are taken to the P&L immediately and recycled. So this is one of the criteria. If it was a cash flow hedge, then we would recycle that equity reserve to the P&L. If it was a fair value hedge, then it's in the P&L anyway, and we just discontinue it to the P&L. So here is Colat. Colat had a hedge of a commodity price risk in aluminium. Colat had an issue because they had a climate disaster. And so it hedges commodity price risk in aluminium, and such transactions were classified as highly probable in accordance with IFRS 9 financial instruments. This is a cash flow hedge. However, the purchases which were considered highly probable prior to the natural disaster are no longer expected to occur. Discuss how the hedges should be accounted for in the financial statements. Because it's telling you it's highly probable, it's a price risk, you should automatically know it's not a fair value hedge, it's a cash flow hedge. So the first thing we say, it hedges risk, it's highly probable, and it's a cash flow hedge. It should follow hedge accounting principles up until the date of the natural disaster, and then it should cease hedge accounting. Cash flow hedges are recognised through OCI and accumulate in an equity reserve. As the forecast transaction is no longer expected, it should reclassify any gains and losses in that reserve from other comprehensive income into the profit and loss as a reclassification adjustment. You literally do debit, credit, OCI, getting rid of the reserve, and you recycle it into the P&L, debit, credit, P&L. Okay, so that is cash flow hedges. Again, something that could come up in your exam. Please make sure you go over. And then finally, just want to cover off IFRS 18 again, just so you're remembering, it's not just about management defined performance measures. It's not just about operating, investing, financing, taxation, and discontinued categories. It's also about consistency, comparatives, labeling, offsetting, and aggregation. Okay, so remember, we need to label things effectively, not just call them other. If they're material, they need to be shown on the face of the P&L and the statement of financial position. We should only be offsetting things which are required by IFRS. Otherwise, we're hiding their true identity as an asset or a liability. Aggregation, we should only be aggregating things with similar characteristics. We should de-aggregate things which don't have similar characteristics. So that could be tested too. This could be tested, the operating section by function or nature. Understand what the admin and distribution cost category by function, what are the benefits of it? And understand if it's by nature, employee cost and depreciation, what are the benefits of it? Could be asked about. So understanding that or that is important. And then also, how else could it be tested? Well, remembering all the pro formas will be in the new templates. Remembering IAS 7 has also been updated. It will start with operating profit now. And interest paid is now financing. There's no choice. It should always go through financing. It used to go through operating. In the P&L where items be misclassified, you're going to have to be explained why it shouldn't be in there and it should be moved. And we did a question on that. Always consider what is the main activity of the business. Go and check whether it is in investment properties. Go and check whether it's a financing, i.e. a bank. If they are the main activities, then of course they would therefore all be in operating. So be careful. In the past, ACA have expected answers to simply state this will be recognised in the profit or loss. We're now expecting it to be in either operating, investing or financing. So think about that when you're writing your answers. How is it going to be tested? Continued? As I said before, it could be a discussion about presentation of expenses using nature or function, over-aggregation or offsetting, separating out material items, or current and non-current presentation. Usefulness of disclosure notes, including whether they embody the principles of IFRS 18, remembering judgments, remembering management performance measure, management defined performance measures. So identifying those with an explanation and assessment of disclosures and whether they're useful to stakeholders. We did a question on that in the last live. So well done. I have gone over time, probably started a bit late. I'm happy here to answer any more questions if you've got any. Other than that, I'm going to say good luck to everybody.